everyone. Let's come back to the booming credit markets. So we saw in last week's video how the crossover zone is showing some improvements. But beyond the crossover zone and the BBB and BB ratings, the trend is visible in all high-yield categories. And for the first time ever, the average yield to maturity in US high yield fell under 4%. 4%. Can we still really talk about high yield? We all know that the huge amount of liquidity injected in the markets triggered a yield hunt. And investors are feeling confident to increase their risks to ensure minimum returns. And the hunt is far from being finished, and it reaches the lowest grades in high yield that are CCC ratings. The average yield to maturity for CCC bonds is also reaching a low, 6.2%, and this 6.2% of yield to maturity is inferior to the average CCC coupon. Said in other words, it means that CCC companies can currently issue new bonds with lower rates than their existing debt. It's not the first time this happens, but it's very rare. The last time was in 2014. So what does it mean concretely? It means it's a great window of opportunity for CCC companies. The low in yields in CCC were reached on February the 8th, and one day later, great timing, a CCC company named Party City issued a bond. So Party City is a company selling party accessories, and with social distancing, parties are not really in vogue at the moment. Last year in May, Party City entered the distressed space. Its 2026 bond was trading at a price, not a yield, a price of 4.9%. But the company is now back in the game, and with a very good timing, Party City has managed to extend its debt maturity profile and issued a 5-year bond. Initial talks for the yield were between 9 and 10%, an initial amount of $725 million, and they have put all their assets in guarantee. $4.6 billion of order books later, they issued a bond with $750 million, so 25 more, but a coupon of 8 3/4. We could think that starting conversation with a coupon between 9.5 and 10 and giving an effective coupon of 8 3/4 could harm the price of the bond. But no, it didn't. The bond was priced at 100, and the first prices in the market were 103. So this example shows the hopes in the market for a quick resolution of the pandemic, and also the intensity of the yield hunt. Because lending money to a company with the lowest rating, with fundamentals that were under pressure even before the pandemic, with all stores that are closed and with products that can't be used, says a lot about the party that credit markets are currently having. Thank you.